Well, besides keeping a close eye on the trading glitch at the NYSE, as well as what's going on in Greece, investors also digested Fed minutes from the June meeting. Let's discuss the highlights with Robert Brusca. He is chief economist at FAO Economics. Bob, welcome back to Arise Xchange.
Thank you.
So the Fed sort of took a pretty dovish view again today, it seems, kind of like taking the foot off the pedal of interest rates a little bit, do you think?
Yeah, it looks like the doves are still in control, but you get a very substantial laundry list from the hawks about all the things that can go wrong if they stay easy for too long. So you clearly have these camps, but as you suggest, the doves are still in charge.
But we're seeing improvement on the labor front. But so what is the concern that the Fed has? Let's start domestically.
Well, they are concerned that the labor market is getting tighter, but it's not really completely improving. The labor force participation rate is still falling. It's back to where it was in 1977. So even though we're making improvements in the unemployment rate, there are some artificial elements to it because people are dropping out of the labor force. So I think the Fed recognizes that some of these statistics are kind of dressed up. They look better than they really are. And you see it in something called the JOLTS report, where you see there are a lot of jobs.
Which is the turnover report, people voluntarily leaving jobs, which is a good sign when people voluntarily leave jobs because they think there's new jobs out there.
Right, but the quit rate, which is what you're talking about, wasn't changed at all last month, and it's not particularly high. So on one hand, you've got jobless claims that are very low, which says, hey, firms aren't letting people go, they're hoarding labor. But on the other side, you say, well, if the job market's getting tight, what about people quitting? Well, people really aren't quitting to get better jobs. So the job market is just kind of frozen. And so I think that's the sense that you have in which things aren't really as good as they'd like them to be.
Yeah, and everybody has said that about all the unemployment numbers for some time. We're not seeing wage inflation, and we're not seeing inflation overall. And so that's an argument that you don't need to raise interest rates right now because there's no risk of the economy overheating.
Right. So while there are a lot of excess reserves in the banking system, the flip side of that is that they're regulating the banks with capital asset ratios. And so if the banks were going to try to mobilize those excess reserves, they'd actually have to raise a lot more capital. They'd have to have stock issues, and they'd have to raise a lot of capital. I think that's the reason why these excess reserves really aren't as dangerous as people think, because the banks are being very careful about making loans, because when they make loans, they need to have capital behind it. So they're being very careful.
Okay, so how much is Greece playing a role right now into the Fed thinking, and whether there's any contagion for the U.S., or they have pressure from Europe to keep interest rates where they are?
Well, right now you've got Greece and China, so let's put them together. You've got this big decline in the Chinese stock market you're talking about. A lot of concern about that. It's a big economy.
We're going to talk about
Greece.
that more in a moment, too.
Yeah, and then you've got Greece. And Greece is a big issue because if it gets blown out of the monetary system, then you could have knock-on effects. You know, maybe it will be isolated, maybe it won't. There are just all of these contingencies that we don't know about. So we'll know more this weekend, but for right now, it's a pretty big unknown.
So does this report from the Fed take off the table an interest rate hike in September?
I sure think so.
You do?
You know, you never know how the Fed's going to think about it, but when we look at the things they said in this last meeting, when we look at how things have changed, where the inflation rate is going down, it's not going up. You know, the 10-year note yield has been going down because of all the financial chaos. It doesn't look like the conditions are present for the Fed to hike rates.
And Janet Yellen has said don't look at the Fed hike rates, but rather the path of hikes and what that looks like. So if it's not September, and I know we're getting out there now, are we looking at 2016 now before there's a Fed hike?
That's what I think. I don't think they're going to hike rates this year. But I think that Janet is wrong, because if you take a look at what's been happening, you know, the Fed has had flat rates for so long. Once rates start going up, they're going to continue to go up. So that's why that first rate hike is very important. It's going to be a signal that there's a new environment. So I would completely disagree with her. That first rate hike is a big deal because it does signal a change in the environment.
A change. And does this give credence then to critics of the Fed who say we're in an asset bubble and that they simply are not going to be able to raise interest rates for a long time to come?
Well, we're not seeing, I mean, the U.S. stock market is not up year to date. The Chinese stock market is on the downside of their bubble. So I think you make a hard argument, I think, to say that there are bubbles out there right now. Oil prices are coming down, commodity prices are coming down. You know, the bubble argument, I don't think, has much merit right now.
Okay.